Way back in the early 20th century, Henry Ford said if people understood how the banking and monetary system worked, there would be a revolution in the streets tomorrow. Good thing they don't. Unfortunately, I think, just like in 2008, they're going to find out. But in 2008, like I said yesterday, we were able to hit the easy button. Today, not as much. That easy button doesn't exist. And since our economy runs on credit, meaning banks create money and that cheap credit is what lubricates the economy, it's not really creating stuff. It is the fact that other countries around the world need to save in US dollars because they need to buy their oil in US dollars. So there's always a demand to keep our debt, meaning the US Treasury debt, going lower and lower and lower in interest rates because there's always demand for it. That's changing on the macro level. On the micro level, credit is tightening as well. Our entire economy is credit based. If you look at the average person in America that can't afford $1,000 emergency fund, they have lifestyle creep where if they make more money, they spend more money. And it is just this like kind of false house of cards that our economy is based on. Everyone thinks they're wealthy until that credit dries up. And then what? So if you're a person who realizes this and you realize that in certain circumstances, cash and assets that you actually hold is very important and counterparty risk is a big deal in a credit-based system, then I think you're going to be sitting pretty. I want to take a look at this Zero Hedge article that talks about America's credit card being declined. So this is American consumers, and it says here at the top, the U.S. economy runs on credit. And when American the credit engine sputters, so does the economy. Eventually, if you run your life on credit cards, that credit dries up if you spend more than you make. That's pretty, everyone understands that. And yet, we think the solution to every problem is to turn to the government and ask them to run up their credit card to pay for our lavish lifestyles. And eventually, that runs out. And the time that we have had this decade to fix the problem, we've just made it worse by continually hitting the easy buttons. Easy button. It says here, banks are tightening their lending standards, meaning they're looking at consumers and saying, I don't know if you're credit worthy, and I don't want to go bankrupt by you defaulting on your loan. So they're watching consumers like a hawk, a reliable leading indicator for an economic recession because banks don't just hand out money. Like, of course you'll pay it back because money's flowing. People are losing their jobs. People are defaulting on their credit cards. So banks are a little bit more sus to hand out loans. Over the last 12 months, the percentage of U.S. banks reporting an increased willingness to make new consumer loans has plunged deep into the negative territory, if you see here, which ain't good, especially because it's kind of it makes it even worse because people, money's not flowing because people are losing jobs, and not only are loans more expensive to service, meaning interest rates are going up, people can't even get them. So even if that reverses, like the money becomes cheaper again, meaning the interest rate lowers, it doesn't mean that it's easy to get, right? If these banks are worried about default, that's how they go out of business. They create money by handing out loans. If those loans default, a certain percentage of them, then they can go bankrupt. So banks tend to worry around times like this. Further reading here, banks are wary of making new loans right now because consumer defaults are on the rise. The chart below shows the recent acceleration in delinquency rates on credit card debt. That seems up and to the right. We call that a parabolic rise. Not a good trend. And people can't save. And do you think the average consumer in the United States who cannot afford $1,000 emergency fund, just Google, like, listen to these people. Sometimes they openly talk about how much debt they have, and that's not even counting the fact that if you look back here in 2021 and 2022, guess what didn't have to be paid? A lot of people still didn't have to pay their mortgages. A lot of people were still in that housing we had this kind of artificial, like, there are consumers in the United States that didn't pay their rent and instead spent it on luxury goods, didn't pay their college loan and instead bought luxury goods. Not everyone in that circumstance, but it definitely happened, and increased demand, which increased inflation. So all these chickens are coming home to roost, like, okay, these debts need to be repaid. And so these people overspent, and these debts are still due with interest. So obviously they're funding their lifestyle on credit cards. This is in the aggregate, obviously. So it says here, the last round of earnings calls, every major American bank reported a surge in credit provisions, which means capital set aside for their planning on losses for people not to pay. For instance, JP Morgan reserved 2.3 billion for potential loan losses in Q4, a 49% increase from the prior quarter. So what changed in Q4? These loans are starting to come due, these protections, these rent protections and mortgage protections, and guess what else is coming up? The college loans started to have to be paid off again this January. Okay, further reading. But with the defaults on the rise, the banks pulling back on lending, this source of spending is now drying up. And when I say this source of spending, this is the majority of American spending. It's just this house of cards of credit. It's so unbelievable to me that our economy is so wealthy and yet people are so poor. And when I say that, I mean they live paycheck to paycheck to paycheck on purpose. This is a choice. Their lifestyle goes up as their as their income goes up. That blows my mind. That seems like a very stressful way to live, but that's the way the American economy is run from the federal government perspective as well. Which means when that switch is turned off, that free, easy, cheap money, what else do you have? You got nothing. It says here, typically American consumers take out roughly 20 billion to 30 billion in new credit card debt each month. In December, that figure fell to just 7.2 billion. Do you think we're going to have a reckoning in 2023 and 2024? Somebody asked me the other day, when do you think this is going to happen? As these interest rates make their way through the economy, meaning people have to refinance their debt, they have to try to get a new credit card, have to try to consolidate debt. So these things take time. Same thing with the housing market. People have to come to the realization that they ain't getting what they're asking for their house. And that takes time. It doesn't just happen overnight. But they'll lower the price 50,000. Okay, no, we're going to lower it 100,000. Oh wait, still no bites. So the same thing happens in the credit industry. And since our economy is run on credit, these interest rates are going up. That means defaults are going up. That means no one's getting loans. That means the day of reckoning is coming. 2023, I think Q3, Q4, we're going to see it get progressively worse and worse. And the only thing, and this is what I'm worried about, the only thing the federal government can do is hit the print button. That's all they can do to ease the pain. Briefly. That'll make inflation go through the roof. I talked about this yesterday. The Fed can change their inflation target. That'll make asset prices go through the roof because people are like, okay, they're admitting defeat. They cannot get to 2%. And the majority of people in the United States have not realized this, have not realized that there's a day of reckoning. They know there's a recession coming, but they've dealt with a recession before. What's different today? 31 trillion in debt. That's what's different today. And we are in a death spiral, as I've said many times. All right, further reading. Fewer loans and fewer credit cards means less spending, and corporate America is feeling the pinch. The S&P 500 companies are on track to post their first negative quarter of earnings per share growth since the pandemic crash. The only question now is whether Jerome Powell will accept the short-term economic pain. I don't know how short-term it's going to be. We'll see. The short-term economic pain of a recession to stamp out inflation for good. The alternative path of easing rates too soon risks a repeat of the nightmarish great inflation of the 1970s, where Paul Volcker said, okay, I think we got inflation. Is the coast clear? No more inflation? Okay, well, let's lower interest rates back. And then inflation came way back up again. So then he had to raise them to 20%. So the great inflation of the 1970s and a lost decade of economic growth and financial asset prices. Again, our entire economy is built on credit. This house of cards, this kind of like, okay, productivity is kind of a secondary to like free, easy, cheap money and demand for our treasuries. That's how we can run up debt. That's also dying in the macro picture. So I think a day of reckoning is coming for the American consumer because a day of reckoning is coming for the federal government. Because there is going to be less demand, there already is, less demand for US treasuries outside the United States. And methinks that's why there's a lot of crazy stuff going on around the world. The dollar hegemony is losing its power. And the dollar hegemony is what allows the United States to live way above our means. It's the way it is. Let me know what you guys think. Do you think the day of reckoning is coming in 2023, 2024? Do you think it's further out? I'll see you guys in the next one. Peace.